Well, hello, everyone, and welcome back to our February webinar. We're excited that you're here. I'm Greg Patterson, and I'm joined with my teammates, J.A. Kennedy and Tara Gould, and we are with Atlantic Wealth Management. And just excited to have you on. This is our second webinar for the year. We strive to do one of these every month, and just really to our intent here virtually is to share updates on the markets and economy, and provide some timely advice, and really just to give you our thoughts on some things that are taking place. We hope these virtual meetings are valuable for you and your loved ones. We've also posted them up to our website. So if you have friends or family that you feel like could benefit from them, we encourage you to send them the link. It usually takes a week or two for us to get them up to the website after they're recorded and after they're held. So we want that to be a resource for you and to share it with those that you think might benefit and get some value from this. As in past broadcasts, I just want to send a quick reminder that if our technology fails or goes down, just hang tight. We'll do everything we can to get back on the line. And it usually has been our experience that if you're, if you just stay put, we'll be able to jump back in. We're excited. All the work, I think, down Bridges Street and in downtown Moorhead is fiber. So hopefully here in a little while, we'll have much better connections there. So it's not a common issue, but it has happened. So we just give you that advice. And then lastly, if you have questions or comments or anything on your mind, feel free to email us at mackenzie@myatlanticwealth.com, and she'll be glad to take your questions and get those to us. If we have time, we'll share those. If not, we'll get back to you directly. And of course, you can always call us here at the office. With that, let's get started. And I want to go over what we're going to discuss today. You'll see the agenda there on your screens. As in past webinars, we're going to talk through current market returns and just give you a quick snapshot at where we are both today and year to date. And we're going to go over some economic data that has come in for the month of February. And that's always been valuable to see where we are. Quick dashboard of indicators there, both from a recession standpoint and the leading economic index that we follow through the conference board. We're going to talk through both of those. And we're also going to share some economic and market updates and summary. So you've got that. And then we're going to talk through some tax season information that is very beneficial. We think it will be helpful for you to see this as a reminder for those of you who already are set up and ready to go, but also to help folks joining the call who might not have this latest information on tax season stuff. So we're going to talk through that as well. So let's kick it off with Tara giving us a quick update.
Sure thing. So the first chart we're going to look at is S&P 500 year to date. So it'll be January 1st through today. Remember, the S&P 500 consists of 500 leading publicly traded companies based on market cap or market capitalization. We do commonly quote this index as it's considered one of the best gauges of the US equities market. And so what we're looking at here is the most recent year to date. There was a market low that you can see on this chart. This is on January 5th. And the S&P 500 was trading around 3,800 at that time. And then also in this chart, you can see that we've had a year-to-date high, and that occurred in February. For the S&P 500, this was on February 2nd, and the index went above 4,000, to be exact, 4,179.76. Right now, we're currently trading around 3,900, so that puts us year-to-date S&P 500 up around 4%. And the next one we're going to look at is NASDAQ. Again, this is a year-to-date chart, the NASDAQ index. It's another staple when it comes to talking about financial markets. NASDAQ consists of about 3,700 companies stock. And you'll note that NASDAQ is heavily weighted in technology, more than half of the index. So we saw on January 5th, again, we saw a low in the NASDAQ, 10,305. And then we peaked year to date on February 2nd at 12,200. Right now we are trading around 11,400. So that puts us year to date on the NASDAQ up over 10%. And then the last index we have here to look at is the AG, and this is the Bloomberg Aggregate Bond Index. We call it the AG. The AG tracks the performance of U.S. investment, corporate and government bonds. And for the AG, we had a low, which you could tell is a little bit more recent. This was on February 21st. The AG dipped down to just over 97. And then we had a peak actually at the beginning of February where the AG went above 100. Now we are trading close to 97. This does put the AG in a slight negative for return for year to date.
Cool. I'm going to jump in here now with just kind of an overview economic update, looking at data over the last few weeks. Before I jump to the slide for that, though, I wanted to stick on this slide for a minute. You can see there, and as Tara pointed out, and the equity market slides, it was really around the beginning of February when we kind of topped out as far as year-to-date numbers. Mm-hmm. The significance of that, I think, was the employment report for January that came out right at the beginning of February 2nd, I believe, which was much better than expected. We created over 500,000 new jobs for the month of January, and the unemployment rate dropped down to 3.4% from 3.5%. And so this is really the fixed income market on this chart here. You can see the impact of that, I think, was the market assuming that the Fed, it gives the Fed ammunition to continue with rate hikes with a healthy and strong jobs number. So, and similarly, on the equity market side, we've seen the same trend. So a great start to the year, the first 6 weeks or so, or first four or 5 weeks or so, and then we've been on a downward trend over the last few weeks. So just an overall kind of highlight of the economic data. I put inflation, the CPI and PPI here at the top, and the employment, that second bullet, and initial jobless claims, because I think those are two of the largest factors as we go forward. I mentioned the employment report already. We also track initial jobless claims, and they have, since the second week of January, they've remained under 200,000 weekly on the initial jobless claims, which is a very healthy number. So even though we've seen companies announce layoffs, even going back into last year, the second part of last year, and particularly the fourth quarter, we haven't seen that translate into the jobless claims numbers as of yet. On the inflation front, we had the January CPI number come out the second week, or maybe it was the beginning of the third week of February. I think it was the 13th. And that gave additional ammunition, I think, to the Fed for continued rate hikes. The year-over-year number on the consumer price index did drop down slightly from 6.5% to 6.4%, but that was not as much as the trend had been. So we'd previously gone from 7.1% down to 6.5%. And so it's a very, very minor decline. And the month-to-month number actually went up from December to January. So again, the Fed, I think their number one task, or the way they view it right now, is combating inflation. And so that the fact that inflation didn't continue on the same type of downward trend may give them additional ammunition as we go forward. The PPI, which is the producer price index, that just tracks producer prices as opposed to consumer prices. same data there, basically. It was down year over year slightly, but month to month was up. So those are the two big things, inflation and employment. The data, though, overall is still mixed, as we've talked about before. The housing market obviously has been impacted by the increasing rate environment. So we've seen housing starts, existing home sales, building permits, all of those numbers are down year over year. Retail sales, on the other hand, for January was a pretty strong number. It was up from December, and we're still, the rate of retail sales, the increase over last year is 6.4%. So that's right on par with the rate of inflation. Ultimately, we kind of look at, what the trajectory of the economy is dependent in large part on the consumer and consumers continuing to spend. So to continue to see a retail sales number on par with inflation is a positive, but we'll see how long that trend is able to continue. Industrial production, on the other hand, would be a negative. We have seen decline in industrial production year over year, even though the month-to-month number remained consistent based on the latest report. So that would overall industrial production was kind of holding its own through most of the year last year, but we've seen the decline over the last 6 to 8 months. Gross domestic product, this is what we measure kind of overall economic output with. And we had last week the second estimate of the fourth quarter gross domestic product number, which the first estimate was the end of January. That was 2.9%. This latest estimate revised that number down slightly to 2.7%. That would still be at a level where we would say a pretty decent rate of economic growth. And that's on the coming off of a third quarter annualized number at 3.2%. So the second half of last year, we've seen pretty strong economic data in terms of the GDP. We will see how long that can continue. Again, there's a lot of headwinds, as we mentioned, with the Fed and interest rates. And that last bullet point there, the Fed has the task of digesting all of the economic data and then making a decision on the federal funds rates and what action, if any, to take on those. So I think the market in general started the year thinking that maybe we were on the short roads of Fed rate increases, but with the CPI data, the employment data, I think that has kind of changed in terms of market expectations. So that's kind of general overview, and I'm gonna let Greg talk just about inflation just for a moment.
Yeah, and so Jay's comments about the Fed, really, I'm sure many of you have the question of, well, why is the Fed raising interest rates? And the primary reason is to slow down the cost of goods and services rising. It is the one tool that they have that they can maneuver that Fed funds rate. And so that's why they're raising interest rates, is because of inflationary numbers in the data. So this button, is something that we were talking about earlier today. Whip inflation now. Some of our more senior clients are clients who are a little knowledgeable back to 1974. You would remember this button. Gerald Ford became president in August 74, and the campaign at that time was centered around bringing inflation down, which was over 12%, I believe, when he took office. So it's interesting to note that some of the skeptics of this marketing campaign turned the button upside down so that it would be NIM, which stood for no immediate miracles, nonstop inflation merry-go-round, or even need immediate money. And so there was a very bad economic situation going on following the 1973 oil crisis. And inflation back in that time period was probably one of the worst times that it's ever seen, even more so than where we are now. Interestingly enough, Alan Greenspan was the chairman of the Council of Economic Advisors during the Ford administration. And in a book later, The Age of Turbulence, he would recall that he thought it was a stupid idea to come out with this marketing campaign, but he ended up going along with it. But nonetheless, it was Greenspan, through raising interest rates, that really did bring down inflation in the early 80s. And so that's why we have rising rates, to bring down inflation. It is something that all of us are being impacted by, and it is the one big headwind that stocks and bonds alike are having to deal with. So Jay gave the news on the numbers there. It has come down from its peak last year to about 6.4% on the consumer price index and 5.6% on the core, which is just taking out the energy and food, your groceries. So, and that was year over year ending in January. So the Fed has a 2% target on that. We'll see how that goes this year. We expect them to increase rates another three times by a quarter point each time, and perhaps a rate cut at the latter part of the year if the consensus around this inflation and recession data remains. So just a little bit of history and nostalgia there. If you have a win button left over from 1974, drop it by the office. We'd love to see that and enjoy some history in the making. I'm going to turn it over to Tara. She can share our recession risk indicators dashboard and talk you through that.
Sure. So first of all, what is a recession? It's a significant decline in the economy, overall economy, and it typically lasts more than a few months. So when a recession begins, the economy reaches a peak of activity, and then the recession ends when the economy reaches its trough. Between trough and peak, remember the business cycle up and down, the economy is in expansion, keeping in mind that expansion is the normal state of the economy, and most recessions are brief, and they have been rare in recent decades. So when we're looking at the dashboard, this has 12 different economic indicators, and this is used to assess the risk of recession. We've been tracking this. We do talk about this on our monthly market updates. We just like sharing these charts. What you'll notice for the latest information is we do have two indicators that are the green arrows pointing up. That signals expansion. Those two are the jobless claims and also the truck shipments. Job sentiment has recently turned yellow, which is cautionary, while the other indicators are signaling recession. In the past, the recession indicators, once turning red and indicating overall recession, it's been an average of about 3 months. You can note that current conditions, that hasn't happened, but past recessions have occurred up to 13 months after the dashboard has crossed over to red. And then this next one here, these are just historical recessions, and we like to look at what the dashboard looked like at that time. As you can see in prior recessions, all or almost all indicators were signaling X, which is recession. We are close, but we still have a few indicators hanging on.
All right, the U.S. leading economic indicators, the U.S. LEI, it's an index that we track that really is a forward look at those economic indicators, the 10 leading economic indicators that would point towards a recession or an expansion. The blue line, if you go to the left, is 2000. The gray vertical bars are recessionary time periods, and you can follow that and see that it does point to recessionary time before it actually takes place. And the red bar there going across is a recession signal. And you can see on the right part of the chart, the blue line has started to point upward. But the overall index is still down. It was down 0.3% in January, following a decline of 0.8% in December. And it's down 3.6% over the 6-month period between July and January. So, it's a downward trend, but again, I think it's just an indication of things to come. As you can look at the gray bars, typically that index does turn upward during the recession. And the last one being 2020, you see that sharp inversion there. January's numbers do show a little bit of improvement there in the chart, at least. But this is one of the things that we keep you up to date on. And, again, I think the consensus around a recession is pretty strong by most of economists, and this index is one of the things that they track as well. Economic and market summary. This has not changed from our last webinar in January. So we still have the recession dashboard signal being a red X for a recession. One thing I did not mention to you when I talked about the WHIP inflation now button from 1974 was that the Dow Jones Industrial Average, which is a pretty big number today, over 32,000 on the Dow. It's what you see on the evening news, or if you pull up your stock market quotes. In August of 74, it was in the, I believe it was in the 700 range. So, you think about that over a 50-year time span, there's been a lot of economic indicators, both good and positive, and bad and negative. So what we want to stress to you here is this is part of a normal business cycle. It's not something that, you should really get spooked about, but it is part of that normal business cycle. We just like to communicate to you. And we see that a narrow path for a soft landing does rely on a resilient consumer, which we have. Jay mentioned spending, consumption, as well as the employment numbers. And it also says, and/or corporate reluctance to invoke a full-scale layoff cycle. We have seen layoffs increase in the tech sector primarily, and that has been ongoing for the last several months, but it has not shown up in those employment numbers as of yet. On the U.S. market outlook, we still see that the downside to earnings expectations appears to be the primary risk this year. We also continue to believe that markets will experience heightened volatility until visibility is restored regarding the path forward for the economy and for earnings. And historically, bear markets are rare and typically provide good opportunities for long-term investors. We still see that that's the case. And as we manage money, we don't recommend that clients have 100% of their capital in the markets, but that they follow a tiered approach where they do have cash and short-term reserves for those upcoming needs. They've got intermediate funds set aside for things like educating their grandchildren or children, or needing a car purchase in a couple of years. And then lastly, the longer term needs would be in longer term investment vehicles that could rise and fall, and you could weather these storms.
I think it's important to note too, and we've said this before on these webinars and client meetings, but there's really not a historical precedence for what has gone on over the last few years with just stopping the economy, starting it back up in the midst of COVID, and then dumping a lot of money into it from a government stimulus standpoint. And so it has made it difficult. If we look over the last 18 months, try to find someone who had the story right on inflation or on what the Fed was going to do. And so here we are, today, and we're kind of in that same spot of the economy working its way out of what has gone on over the last 2.5 years. So we can look into the crystal ball and try to predict what's going to happen. But I think the more important thing is that we are staying on top of the data as it does come out and trying to position, clients' funds money in a way that we're mitigating risk on the downside and then trying to take advantage of opportunities where we see those.
Yeah.
We're going to shift gears just a little bit to provide some tax season updates. You guys know tax season is in full swing, and just want to take a moment to familiarize you with how to obtain your tax documents if you are set up for paperless preferences, and we'll talk about that a little bit later. So this first visual that you're going to see is our website. This is the landing page. If you go to myatlanticwealth.com, I recommend clients go to this site in order to link to their investor 360. It seems to be the most straightforward way, not causing you issues. So what you'll see at the top is there's a button that says client access. It's circled in red. You click on that. And then the next page that it's going to send you to is, if you scroll past that picture, there is a little button that says Investor 360, and that's what you'll click on. And when you do that, it's going to prompt you to log into your Investor 360 account for your login ID and password. If for any reason you have forgotten that information or need to reset it, need to be reminded, you can just contact us and we'll be glad to give you your login ID, and then also we can reset your password for you so that you're able to log in. Once you enter that information, there is going to be a, what do you say, third factor authentic?
Multi-factor.
Multi-factor, I was gonna say third factor, multi-factor authentication. And depending upon how you have that set up, most people have it sent to their cell phone. So a passcode will be sent to your cell phone via text, and you'll be able to enter that in and access Investor 360. The next page here is what your account is going to look like. First, you're going to land on that profile tab, but what I'll ask you to do is to over where it says statements and documents. You're just going to click on this tab, and you'll see any statements or correspondence that you've had. But under tax reporting, this is where you're going to find your tax documents. And if you click on most recent, that's going to pull up your most recent tax form. When after you click on that, the next thing that's going to pull up, depending upon the type of account that you have, is first we'll start with taxable accounts or non-retirement accounts. And you're going to find a consolidated 1099. What you'll do is just click on that button that says PDF. That's the easiest way. You can pull it up, save it down, and if you have a CPA, you can securely email that to them. If you want to print it off and send it, that's another way to do that as well. But what a consolidated 1099 is, includes 5 different 1099 forms. So most familiar is 1099 DIV, dividends. You probably got the 1099 INT before, but there are others, a 1099B, a 1099 miscellaneous, and possibly 1099 OID. On this bottom one here is a 1099R. So this is what you're going to see if you have retirement accounts as far as tax forms. The first one, 1099R, is if you've had distributions from your retirement account. If you have not taken distributions from your retirement account, you're not going to have a 1099R. So this could be for traditional Roth IRAs, annuities, certain payments from life insurance contracts. Also, just a side note, if you have a pension, like workplace pension, you could also get a 1099R for that. Not going to come from us, but going to come from the company you have the pension with. The other one I wanted to mention here was Form 5498. Everybody's going to see this if you have a retirement account. This is just an informational statement. It's not a required form that you need in order to file your taxes, but just become familiar with this form. It does have your IRA contribution information if you put money in for 2022. It identifies what type of retirement accounts that you have. It will also show any rollovers, transfers, or conversions that occurred last year. And then lastly is the year-end value will be on that form as well. I think we skipped one, Jay, did we?
Wait.
Okay, no, all right, go ahead. So this is one thing I wanted to show you for paperless preferences. So some clients have asked, am I going to receive my tax documents in the mail, or are they going to be electronic? So one of the ways that you can check, or if you want to change your paperless preferences, is if you log into Investor 360, again, we're on the main page. There's a button at the top that we've circled here that says settings. And once you click on that, it's going to take you to the next page. Scroll down a little bit and you'll see what's called paperless preferences. And so this is where you're going to be able to go in, and each of these arrows here, you can either click or unclick. And so what you're doing is any of the documents that you have a blue check mark here, those are going to be e-delivered, which means you're not going to get them in the mail. You're going to actually need to log on to Investor 360 to be able to view those, save them down, and print them. Okay, this is the one I was looking for, I thought was next. So early February, we did send out an email with some important tax information. I just wanted to remind everyone of some information that was in that email. We included 2 key financial data cards. These are actually front and back, so it'll be 2 pages for each. We included 2022, and that shows you just all the numbers, whether it comes to tax brackets or retirement contributions for 2022. And that can just aid you especially if you're self-filing your taxes for 2022. When thinking forward and thinking about planning for 2023, we included the key financial data of 2023, again, which shows those updated tax brackets. Some retirement account contributions have increased, and want you to just be aware of that.
All right, thanks, Tara, for that. And as always, we get calls and questions during tax season. Feel free to reach out to us. Also reference back to the email that Tara spoke of. There is dates there for when tax forms would be generated. As always, we're glad to provide service to you. Noel, Mackenzie, Tara, J.A., or myself, just let us know. We're glad to help. We wanted to highlight a qualified charitable distribution. This is a planning technique that you can use if you have an IRA and you're 70 and a half. You have to be age 70 and a half to make a qualified charitable distribution, but it's a direct transfer of funds from your IRA to a qualified charity. It could be your church, your alma mater, any nonprofit in the area. If you are giving money, you're a donor and you're 70 and a half or older, you have the ability to do this, and it keeps that income from hitting your tax return. So it's a very good planning tool that can be used both to help you make charitable contributions, but also to reduce your taxable income. And if I say reduce, if you're 70 and a half, obviously it's not going to show up on your tax return. But if you're taking your RMD, it could be a way to reduce your income in that respect. The 1099-R will not differentiate between taxable and charitable distributions. So it's important that you maintain correct records and document the distributions appropriately when filing your return. And so we did send out a letter to folks, our clients who had made charitable distributions from their IRA, to let them know what that was. And they can include that with their tax documents to their CPA if they self-file, you would just need to note that. And you will report the full IRA distribution, but you'll just have to subtract the amount that you gave from the taxable amount. And so the action item is charitable distributions can be given throughout the year. You don't have to wait till the end of the year. You can do that now. And many of you have giving strategies. If you have an IRA and you don't know this, you might not be a client on the call with us. Or if you are a client and you just turned 70 and a half, this is an option for you. You can go ahead and take action on it now. Just give us a call or shoot us an email, or when we meet with you in the coming months, we'll be glad to talk through that.
Great. Thanks, Greg. As we've been doing these webinars, we always like to include and impart just some biblical wisdom and truth. And as Greg just talked about giving, many of us are motivated to give just from an acknowledgement of the fact that God does own it all. And he's entrusted us to be stewards of what he's blessed us with, and just to try to walk that out. Greg and I had the opportunity the end of the week last week to gather with a couple thousand of other Christ following financial advisors from across the country down in Orlando at a Kingdom Advisor Conference. And this passage here was one area of focus for a couple of the speakers. And so just wanted to highlight and share a few words about it. It comes from Matthew chapter 6. So this is the Sermon on the Mount, and Jesus is talking. He says, "Do not lay up for yourselves treasures on earth, where moth and rust destroy and where thieves break in and steal, but lay up for yourselves treasures in heaven, where neither moth nor rust destroys and where thieves do not break in and steal. For where your treasure is, there your heart will be also." And that's, again, Matthew 6:19-21. There's a lot to unpack there, and it's really easy for us to read that, but it's much more difficult for us to kind of live that out. The world would have us focus on those things that are fleeting, that will pass away, that we can't take with us. But it's important. So it's important for us to have an eternal perspective on things, and to know that we all treasure something. We all fill in the blank with something there, and what we fill in the blank with does really control our heart, which then ultimately controls how we make decisions, our actions, words, everything about our life. And so to fill in the blank with something eternal as opposed to something that's fleeting is the challenge for us as Christ followers. So, and that's what we're striving after here across the team. Just wanted to communicate that to you guys. If you have questions about that, I'd be happy to have a conversation with any of you. I think that wraps up what we wanted to cover this afternoon. We appreciate the opportunity for you to join us on the webinar to just go over the market, the economy, some tax updates, and some biblical wisdom as well. If you have questions about anything we have mentioned or would like to further discuss, or if there are others, family, friends, neighbors, coworkers that you know of that we could impart value to by having a conversation with them, we more than welcome that, and appreciate you passing our information along or connecting them to us. Beyond that, we appreciate the opportunity to work with each and every one of you. We value your business and friendship and relationship, and God bless and take care. See you soon.
guys.
Bye.